I want to bring in Gabriela Santos, Chief Market Strategist for the Americas JPMorgan Asset Management. What is going on?
So I think it's a continuation of some of the repricing that we've been seeing for about 5 weeks now. And I do think you're absolutely right. It's very much being driven by a shift higher in yields along the curve. But I think most importantly, in 10-year yields and in specifically real yields. So I don't buy that this is all about higher inflation expectations or a reset in Fed expectations. I think it's very much driven by uncertainty in a different part of D.C. So really, I think we're all bracing for a week from now, after the inauguration, the flurry of information we're going to get and how we can shape our expectations of economic forecasts and risk premium from here on out. And that, of course, reprices assets across the board.
Okay, and so what's the full reprice look like? And when's that happening?
So I do think it's already happening, right? If you look at just the S&P 500, maybe you'll miss it. It's off 4% all-time highs. But the median stock is now down about 15% from its 2024 high. So I do think there's already a bit of repricing and understanding that it's not all good, it's not all bad coming out of D.C. It's going to take us a little while to figure out how it nets out for different companies and the scale, the scope, the sequencing of policy. What, of course, hasn't fully repriced is more of your mega cap tech, your more high valuation, high expectation kind of sectors. And that, of course, could drive a bigger repricing in the index overall, given it's 40% now of the index.
I know that what you do and Jamie Dimon does don't always correlate exactly, but we were commenting on this interview that he did on CBS over the weekend where he called himself cautiously pessimistic as opposed to cautiously optimistic. Do you have the same view?
I would say we're cautiously optimistic about the economic outlook. I think cyclically, really last year was a story of coming out of the cyclical storm, realizing corporate household balance sheets are doing fine. We're normalizing across a variety of indicators, the labor market, inflation. We're also cautiously optimistic about the long-run outlook. Also, a big story last year was the improvement on the supply side and productivity reaching 2%. Where we're more cautiously, I wouldn't say pessimistic, but the reason for caution, we think, is much more in portfolios. There is a cost to pay of very strong but very concentrated returns, which is when we speak to investors, you know, what was a 60-40 allocation is now a 75-25 allocation. What was 50-50 growth value is now 60-40. So there's a lot of a focus on previous winners, big recency bias, and that doesn't set you up for strong returns going forward.
Maybe a curveball, maybe not, because it's obviously in the headlines. Does what's happening in Los Angeles, do you think, have any meaningful impact on GDP over the next several quarters? If not longer. And by the way, you could argue it could have a big impact in a good way, insofar as all of a sudden there's going to have to be an enormous amount of spending. But there could also be losses. So.
Of course. And you see that with natural disasters, right? There's a temporary, at times negative effect, which is made up later as there's rebuilding that takes place, and then it just nets out over time. But I do think it brings up a really important point around when we speak to clients about inflation. You know, we speak about it in economic and market terms year over year. Yes, it's normalizing. But there's a cost there around auto insurance, home insurance, which is not just about California, right? It's about a lot of states in the country. And I think that explains a lot more of the malaise, the frustration about the current costs and about the current economy. That's not just reflected in, of course, how we think about it as economists or investors.
What do you think, just so I understand, what do you think's happened in the last 5 weeks? Meaning, why do you think that the sort of mind shift has changed? Everybody, you know, was in this, I don't know if it was a Trump trade, I don't know what you think it was, but November, December, it was like we are off to the races. And then everybody went for the holidays and decided, or maybe even before the holidays, decided maybe not.
Yeah, really before the holidays, right? So we started pricing in the Republican sweep mid-September. So there was quite a long period there. And then you started getting to December, you know, you start getting into the weeds of the details. Right? So what exactly is going to be the sequencing of policy? How is that going to net out as Is it going to be a net positive, net negative for different assets? And I think for equity specifically, right, there was much more of a focus on the positive aspects and now much more of a recalibration, which can continue this week. On Friday, we're going to get the new CBO forecasts around the deficit and debt projections. And I think that's really what's driving this 80 basis point rise in real yields since early December. And just based on current policy, the deficit is set to rise to 7.5%. And then we still have to factor in the discussions that will start taking place next week and for the rest of the year.